Hi, everybody. Lance Browning, Income Solutions Wealth Management in Tyler. It is not our halftime report. It is not July. It is, in fact, February. But we've been working for the last probably 6 weeks to get something we could send to you to kind of talk about these auto-callable yield notes that we use. So we wanted to go through our structured notes that we use in your accounts and in our own. Unfortunately, a Google search won't do you a lot of good on these specific notes that we use. So we hope this helps out a lot. So why do we use auto-callable yield notes? Well, as long as there have been investors, there will be a need for income, and that's very important to a lot of our clients. So as long as there's investors, they're going to need income from their investments. And the question always is, how do we generate that income as much as we can without buying a long-term bond or taking on a ton of risk? So that's what we're trying to do with these auto-callable yield notes. So this is an example of what we do. So there are two different types of structured notes that we use. The first is called a calendar note, and the second is called a custom note. This is an example on your screen of a calendar note that was available in December of 2018. So JP Morgan offers these for sale to the general public every month, hence the calendar part. Sort of like buying something off the shelf at a store. They're the same for everybody. They sell a ton of them. There's a gazillion of these out there trading. This particular note will pay an annual contingent rate of somewhere between 5.5 and 7.5. We won't actually know what the rate is until after we buy it. By contrast, the custom notes that JP Morgan built for us last month paid over 9%, and we did know that rate ahead of time. This calendar note on your screen will mature in 5 years. Our custom notes typically mature in 4 years. This calendar note has a downside barrier, what we often refer to as a safety net, of 30%. Our custom notes have a safety net barrier of 40%. That's better. This is why we prefer to have JP Morgan, Citigroup, Goldman Sachs, etc. custom build our notes for us every month instead of just buying what's available off the shelf, off the calendar to everybody. So some important things we need to know about these callable notes. So they're going to abbreviate ACYNS, that's auto-callable yield notes. They have a built-in call feature. When a note is called, it matures prior to the stated maturity date, and the entire principal amount is returned to the investor. It's redeemed early at face value. Typically what we use are what are called auto-callable. So auto-callable yield notes have an automatic call feature. The note will be automatically called if certain criteria are met, and we'll talk about that. Also, interest payment. So payment is made to the investor only if certain conditions are met. We'll talk about that. These ACYNS will have an interest barrier, and the worst performing index needs to be at or above the barrier for the interest to pay at the scheduled time, and we'll talk more about that just in a couple of slides. And we'll talk a lot about what are called barriers or safety nets in just a second. Everything we use is the European barrier. That has nothing to do with American investment or European investment. It's just the way they calculate their options at the end of every day. So we use the European, we do not use the American barriers. And let's talk timelines. This is important. So timeline of events when we buy these. So there's a pricing date. This is the starting point. This is when we buy it, when we start off. On the pricing date, the levels are set. Then there are going to be review dates. Those are typically quarterly. So every 3 months, we will look and we'll pay out, if certain criteria are met and all these other things, we will pay out your quarterly interest payment. So we have the pricing date when everything's set. We have the review dates, typically quarterly. When we see whether or not the note is being called and what interest is going to be paid. We'll have a final review date where we look at where we are versus the barrier or the safety net. And lastly, we look at the maturity date. No matter what, this note is going to end at maturity date. We typically use, again, the 4-year custom notes. So let's look at some examples. We don't use American options, so these examples on this slide really aren't going to apply. So here's one we wanted to look at. So this slide may look really familiar to you. If you've been in my office, we've talked about this. So this is how I would explain visually how our notes work. So at this time, we buy our custom notes at $1 on the dollar or face value. That shows here with the arrow down here at the bottom, the red arrow on the slide that says face value, or it'll actually say quantity on your statements and on your confirms. So that shows here at the initial level of 100 or 100 cents on the dollar, $1 on the dollar. This is very important, very important. We have, for example, a contingent coupon or interest rate of say 7%. Out here, where that second arrow is on the right, we have the end of our note, maturity. In between these 2 points, purchase and the call or the maturity, the price that you see on your statement and on our screen will change. And there are 2 reasons for any price fluctuations that we see. So first of all, one is that our structure, what our notes are linked to, will go up and down in price. That's normal. That happens with pretty much any investment that gets marked to the market daily. Secondly, all brokerage firms, all of us, have to have an outside third-party vendor that prices our fixed income on our statements. It's a regulation. We have to do this. So this outside third party has to determine what our notes are selling for out in the secondary open market, if you will. Sort of like pulling comps in real estate. I think that's a good example or a good analogy. With a calendar note, like we saw earlier, there are typically a large number of them out there trading. So you generally don't see as much price fluctuation on the calendar notes due to the outside third party kind of quotes marking them to the market. It's easier to find a price in the secondary market. It's easier on the pricing services. With our custom notes, however, this is a little bit more of a challenge for the pricing services. So JP Morgan, Citibank, etc. built these notes to our own custom specifications, sort of like building a custom home. Because of that, you're going to see more price fluctuations on our statements on custom notes than you do on calendar notes. Again, face value doesn't change, or your quantity doesn't change. It starts and it stops at face value as long as our notes don't mature below the 40% barrier or safety net. So our custom notes can be called, that means redeemed early at face value, after 1 year. Then they're callable each and every quarter. As many of you have seen over the last couple of years, these calls can happen very frequently. All we have to be is up or even on our structure to be called, and typically what we use are automatically called. It's not at JP Morgan or Citigroup's discretion. Or after 4 years, if it's not called, our custom note matures. As long as our structure doesn't mature, and that's the key, below 40% in the notes we use, it will mature at face value, again, quantity, or $1 on the dollar, face value. We've already talked about how that affects interest payments on a previous page, but we'll talk about how likely our notes are to actually breach or go below that 40% barrier or safety net in just a second. So given our 40% barrier or safety net, let's talk about how likely it is for that to happen, that we would go below that. Here is the EFA, or it's an international stock index. It's one that we frequently use in our structures and our structured notes. Again, to lose principal, this would have to mature after 4 years below our 40% safety net barrier. So what if you were that lucky person that invested in this note on January 1, or in this index on January 1 of 2008? As we all remember, 2008 was a really bad year. So you started off in the hole. In fact, you started off in over a 40% hole, but you didn't mature there. You had 3 more years to go. You'll see in 2009, the index was up about 32.5%. In 2010, it was up over 8%. This note, depending on the date that you bought it, may very well have been called, again, at face value, sometime in 2010, most likely. But for argument's sake, let's assume that it did not get called. In 2011, this same index was down over about 11.7%. All in all, for the 4-year period of this note, the index was down about 14% or so. But it wasn't down more than 40%. It matures at face value or at $1 on the dollar. And this is going to be similar to our previous screen. This is a list of annual returns for the Russell 2000, which is a U.S. small company stock index, another index that we often use in our structures. Same story. To lose money, the index in the structure must mature down 40% or more after 4 years. So let's say we bought back in 2005. The index was up a little over 3% that year, then up another 17% in 2006. Very likely, because we were up or even, that this note would have been called in 2006. If we're up or even, we're out. We're called. Face value. To be devil's advocate, though, let's pretend you didn't get called. You were down 2.75% in 2007, and then almost 35% in the debacle that was 2008. At maturity, at the end of 2008, your note would actually have been down about 17% over 4 years, but you weren't down 40%. You received face value on your investment at maturity. Point is, we can't find a rolling 4-year period on these things where we matured below our magic 40% safety net barrier. As always, feel free to reach out if you have any questions on this or anything else. Again, this is Lance Browning here with Pauletta Bonner, Allie Phillips. Always at your service. Appreciate you very much. Thank you.